Good morning, John and Jane. So good to see you guys and delighted to deliver your retirement plan as promised. Of course, this is in a recorded format. Normally, this would be dialogue and we would have communication back and forth. We would walk through things like recommendations together, answer any questions that you would have. Given that this is a recorded presentation format, I'm simply going to present the information to you in the most educational way possible to explain the reasons why we're implementing certain things or the reasons why we want to consider recommendations. And then, of course, we can always communicate over email or over phone, or certainly schedule another meeting in the future where we can meet face to face and have dialogue there. But again, for the purposes of today's presentation, it is recorded. To that end, you may have noticed that I sent you some documents, including a letter, the financial plan, retirement plan specifically. That's kind of the main purpose of our conversation. In addition to a statement of cash flows, net worth is also spelled out in there as well, and a list of recommendations. Today, I just want to talk through kind of a high-level overview of your retirement plan to see how we're tracking, to see what opportunities exist for enhancement. I just want to start off by saying you guys have done an excellent job up to this point. We've got several $1 million net worth. We've got over $1 million in investable assets. Normally, I would be sharing my screen. However, the application I was using today does have a time limit on it, so I decided to just have a video recording. So I'm just going to walk you through this information. I'll guide you where to go. And so the goal of today's conversation is really just to make sure that we have a good understanding of our retirement plan, what actions that we need to take and things to take into consideration. And by the end of our call, we'll actually have an opportunity to talk about next steps and or talk about implementation. So with that, let's go ahead and dive in. So I'm going to direct you to the financial planning document. I like to start high level. And if you go to, it's page 15 of the PDF or page 12, it's like the actual document says page 12 at the bottom. And this is just personal information, summary of your goals. We've got John and Jane, both your estimated retirement ages or perhaps desired retirement ages. Have also made an assumption on living expenses for retirement. You'll see it says $360,000 there. We got your primary mortgage, rental property included in there. We know that as of today, you're paying mortgage payments on those, but those will eventually subside. We also have your college savings goal. I put this in as a want. It wasn't real clear on the information provided how great of a need this was. And I think that's something that we'll want to discuss in a future conversation of kind of gauging, what does education funding look like? Is this something we want to fully fund? Is this something we want to partially fund and the kids have some skin in the game? Is this a nice to have or a need to have? I think it would be helpful to look into this a little bit further, although based upon the preliminary information, it sounds like this is very high on the priority list next to your retirement. So these are the two major goals that I have outlined for you. If we go to the next page, this just confirms basic information, age. We have income accounted for there. We also have your three children, Jarius, June, and JP. We got their dates of birth, their ages as well. One of the things we want to confirm as well is our state of residence. I don't think we have that information on file as of now. I assumed that we were in Georgia, so I put that information in there. We also have John's business, John Jackson Enterprises. So I'm now going to skip ahead to page 18 of the PDF and page 14. Like I said, I like to start high level, and this simply provides us kind of a synopsis or a snapshot of what we would consider your current financial position. And from my point of view, I'd like to tell you that you're in a great financial position. By the way, if I'm looking this way, I'm just looking at my screen with the document. For folks in your age range, based upon just where you guys are at, you're in a very healthy position. When we look at your assets, in other words, what you own, when we take out your liabilities, what you owe, which by the way, the only thing you owe is mortgage debt, either on your primary mortgage or your rental properties. We take those assets, we subtract those liabilities, we come out with net worth, which currently is estimating at $3.8 million. Very strong net worth. Again, most folks, at least historically that I've met, are not in this healthy of a financial position, so I do want to give you a lot of kudos there. One area of opportunity I think that I see from the net worth statement is our retirement assets. In particular, I mean, as of right now, total investable assets are over 1.4 million. Again, very much above average, not something to be concerned about holistically. But one of the things that I think we have an opportunity to do is to make sure that we're prioritizing qualified retirement assets or retirement plan assets, because those can provide unique tax advantages, and those are certainly something we're going to want to explore. We'll talk about that a little bit more in depth today. If you scroll to the next page, again, this is page 19 of the PDF, or page 15 that it says on the document. This gives a little bit more detail. One of the pieces of information that I've outlined in the letter specifying the questions that I have for you are related to ownership of the accounts. I know we both have a traditional IRA, so those are specified here. The other things I just assumed were joint accounts, so assumed joint accounts on the properties, the cars, don't know which one's which for either of you. So get all the assets outlined there and applicable ownership, but if there's any information that is incorrect, we can have dialogue there and make sure that that's updated. The reason why that's important is for estate planning purposes. So like if you own something, but your spouse doesn't, for instance, let's say John owns something, but Jane doesn't own that, it could potentially pass through probate or be subject to taxation, versus if you have joint tenancy with rights of survivorship, or more commonly in a marital situation, joint tenancy by entirety. This means that you would inherit that asset outright. So just some important context there. So if you have that information, just feel free to pass along some statements, or if you know that information offhand, just let us know. We can confirm that. And then if you go to the next page, you'll notice this is page 20. We also have your outstanding debts. Again, also just mortgages at this point. From my perspective, not a huge red flag, because if there's on the spectrum of debt, there's good, there's bad debt. This is probably better debt than most, because it is mortgage debt. It's tied to an asset that has value, that has the opportunity to increase in value over time. The only thing to consider is it is a large amount of debt, about $2.5 million. And when we're going through the statement of cash flow, I do have some questions there related to what we're paying on the mortgage. And this may just be some gaps or information that we need to fill collaboratively, or it may be a greater issue that we need to address. So again, we'll get to that here momentarily. Let's direct our attention to the statement of cash flows. Again, that's one of the statements that I provided you. This basically summarizes total income coming in and total expenses going out. So incoming cash flows versus outgoing cash flows. I made some assumptions on taxes, including federal, state, self-employment tax. Again, one of the reasons being we don't know the structure of the business, so I went worst case scenario, assuming we have some self-employment tax. And of course, we have Social Security and Medicare built into that. When we include taxes and we scroll all the way to the bottom, there is a projection where we're actually negative cash flow. So that's where I think that it's an area of opportunity. Now, that being said, I think that there are areas within the budget, within our discretionary cash flow, that adjustments can be made. For instance, we're giving quite a bit to charity. There's a category of miscellaneous expenses that is pretty high on a monthly basis. We're spending $3,000 a month on entertainment. And those are just examples, right, of things that perhaps we could change. And even so, like as another example, we are paying for private school for our children, right? All these expenses add up. At the end of the day, I'm not going to tell you what you should cut. It's not my position to tell you how to live, because I'm here to actually empower you to live the life that you dream of living. That being said, just financially speaking, we have to live within the means that we have. So I would challenge you to think about some things like, what are we willing to or can we change from an expense perspective? So, I would think of it through the lens of things that we choose to spend money on versus the things that we need, and really having a thoughtful kind of self-reflective exercise, determining, what do we need? What do we want? What are we choosing to buy? What are we absolutely essentially need? Once you have a clear delineation there, it'll be a lot easier to determine, okay, here's what we can cut. Because again, this is just based on the projected mathematics. One thing I think that's also worth noting, I was looking at your residences and the mortgages based upon my calculations. assuming that they're starting today, a 30-year mortgage rate going all the way, or 30-year mortgage term going all the way to the year 2056, each of those mortgage payments are a shortfall. In other words, we're not paying the full amount that would equate to a 30-year fixed year payment. So that being said, do you guys have some offsetting income from like rental? Because it says we have rental properties, but I don't see any report of rental income. And maybe we're just tabling that. We're assuming that that's going into the mortgage expense, and maybe that's why we've reported lower mortgage expenses. And I totally get it. Like that's not weird. Sometimes folks just think, well, I use that to offset my mortgage expense, and this is how much it offsets it by. So if that is indeed the case, then just from an income tax perspective, and even from just our perspective, when we're looking at, okay, what is the total income coming into the household, we would consider rental income as part of that income. So that's just one thing to be aware of, that is kind of some homework for you to determine, or just something that we need to connect on is, okay, do we have a shortfall on the mortgage? Are we just not paying enough? If we aren't paying enough, I think that there's free cash flow here that we can move around to make sure we are paying enough, or different expenses that can be cut. So again, just something that I think we need to consider, because reality is you guys are in a great financial position, and I think there is a path forward for saving for your retirement. But if we are negative cash flow and none of this cash flow is going to savings, at least according to the current statement, that it's going to be detrimental towards long-term retirement. So again, just some things to take into consideration there. So that's the statement of cash flows. Let's go back to the financial plan. I'm probably going to skip around here a little bit. I want to talk about investments. Another area of opportunity, actually, no, let's go to page 27 of the PDF, or it's page 23 on the document itself. This is kind of a mountain graph. Mountain graph really just shows us going up the mountain or building wealth, and then coming down the mountain, drawing down on our assets for retirement planning. This initial graph that we're looking at is based upon the information that I have now. In essence, we're assuming we're not making contributions towards retirement, whether that's to our brokerage account or to a retirement account. So we don't have any retirement savings going in. This just assumes that money is increasing at a compounding rate of interest based upon the underlying asset allocation, which currently are about 60-40, 60% stocks, 40% bonds, based on the information you provided us, and your income. Assuming all of those things and no contributions made to retirement, we're projecting that assets at retirement would total roughly 4.8 million. And so, you see different blue colors here, just basically it stacks on itself. So a little over 4.4 million. Now, a lot of folks sometimes think about, well, how much do I need for retirement? That varies. That varies from person to person. And that's very much driven by what your desired lifestyle in retirement is going to be. Some folks want $80,000 a month. Some folks may want $10,000 a month. Those are very different needs, therefore warranting very different portfolio nest eggs. So again, that being said, assuming we just draw down from assets in retirement, we're basically projected to run out by the year 2062 or thereabouts. And that, generally speaking, we plan conservatively for retirement. So we're projecting that you're going to live till age 95. That may or may not happen. I'd rather have enough assets to get to 95 than not. If we get to 85 and you're like, I've still got some life left in me. So being that your biggest concern is retirement, I think that this is something that we need to address. And there are ways to get us on track here. And that's kind of what we're going to walk through today. So if we go to, I'm going to redirect you to the list of recommendations, and let's just talk through some of the things that I'm going to recommend that can get us on track for retirement. So first things first, these are just general financial planning recommendations, all kind of guided through how we're going to set ourselves up for long-term retirement, because your desire is to maintain lifestyle. and retire at some point in the future. One of the things I want to talk about regarding retirement is what does an ideal retirement look like? Is this something that we are doing as early as possible, or are we trying to live exactly like we live today? Is there any wiggle room? I've specified some of this information in the letter that I sent you as well. But I think it's a good conversation to have to determine what your non-negotiables are and what your negotiables are for your ideal retirement plan. With that being said, I've got some cash flow planning recommendations here. This is kind of the bedrock foundation. You guys already have about $150,000 sitting in cash, which is really healthy. I think based on your non-discretionary spending or your mandatory spending on a month-to-month basis, you're spending roughly $26,000. So $105,000 works out to roughly 4 months, which is fine considering you are both earning wages and in both relatively secure incomes. So I'm okay with being on the bottom end of that spectrum. So I think we have some opportunities to deploy some cash there. For John's business, I think it's worth considering keeping some cash on hand separately. And that's also a conversation to have is, do we have a separate bank account? If not, then that may be something we need to look into. Usually 6 to 12 months, just depending on the business. Sometimes if a business is more seasonal, you might want to have a little bit more cash on hand. If you have more consistent cash flows, then that need of cash is maybe not as great. We also haven't talked about the financials of the business. I know we got $800,000 worth of revenue, and it looks like we're making a profit because we're taking a distribution. But if there's anything that we can have a discussion regarding the business, that's something that we can have a discussion regarding. Again, I have those mortgages called out there. That's basically showing the shortfall for each of them. So on the primary mortgage front, we've got $4,300 short. Rental property, we're $600 short. And then the second rental property, we're about $1,000 short. Again, if these are offset by rental income, just pass along what rental income we're receiving and we can incorporate that into your cash flow. And then, of course, whether it's reducing spending or utilizing retirement accounts, which are tax advantaged, I think there's opportunity to reduce cash flow and taxes moving forward. Again, we just kind of had a high-level discussion there. So in terms of retirement planning, apart from, again, finding ways to minimize discretionary spending, once we have some cash flow to work with, then one of the things that I'm going to recommend for John is opening a SEP IRA. SEP IRAs are a business retirement plan that are great for small businesses. In your case, we got about 4 or 5 employees, including yourself. And so it's a great small business retirement plan because it's low costs, very easy to maintain, and you have the discretion to make contributions on your own behalf and on behalf of employees. The one caveat you do have to be aware of is that if you put in, let's say 10%, you also have to put in 10% on behalf of your employees. So that's one thing to consider. However, you do have quite a bit of capacity to save into the plan, upwards of 25% or $72,000, whichever is less, based on your income. You could probably, at maximum, save about $60,000 into the SEP IRA in 2026. But my recommendation is if we can get cash flow to $50,000 of money that we can save into your IRA, again, that's going to significantly reduce our taxable income and also give us an opportunity to pad our retirement savings over time and build up those qualified assets, right? The retirement assets I was talking about. So in a SEP IRA, it's a qualified retirement asset. Those earnings will grow tax deferred, meaning you're not going to get taxed on it right now. You're actually going to get taxed on it in the future. So for someone like you guys are high wage earners, we can save a lot of taxes going this route. One of the things that we're going to look at in detail in the future, and I have this detailed out in the financial plan, is Roth conversions. In fact, let me just draw your attention to that separate document. If we go to the financial plan, and it's actually one of the last pages, we have a couple of pages actually. If we go to page 42, you'll notice that we've got those yellow bars. Those yellow bars are what are called Roth conversions. In essence, we're taking IRA money, non-Roth assets, converting it to Roth. What that does is it's a taxable event, so we'll pay taxes at that point in time, but we're actually going to save ourselves a significant sum of taxes. We're projecting north of $1 million in long-term tax savings. Again, this is more theoretical at this point because we don't know what assets are going to look like. We don't know how many retirement assets that are pre-tax are going to be there. So these are things that we're going to work through together over time. But just to give you an idea of what our retirement planning will look like down the road is we're always going to be thinking about ways that we can optimize for taxes and minimize your tax liability so that we can maximize your out-of-pocket earnings, your after-tax earnings in retirement so that you can live the life that you want to live. So that's just a high-level thing that I want you to be aware of and I think is a helpful illustration. Based upon where we're at today, I think that there's a lot of opportunity. Normally, when I'm sharing my screen, I would have already gone through what we call a Monte Carlo simulation. You may have noticed when going through the document, you see these levers, and there's a percentage, so you got purple. In fact, it's actually the page right before this page, the tax planning analysis. You notice we have purple, we have green, we have blue. This is in essence a synopsis of what we call a Monte Carlo simulation, where we run 1,000 different trials. Best case, worst case, and everywhere in between. We have good markets, bad markets, mediocre markets. We have big returns in the positive and big returns in the negative. We have good things happen, bad things happen. Any random occurrence that you can think of, it basically simulates 1,000 different occurrences. And it gives us a probability result. In other words, based upon our situation, what is our probability of success? This 81% that we see here on page 37, again, right before that tax planning analysis, it's page 41 on the PDF. This says with some of these strategies I'm recommending, the saving $50,000 to our retirement, the utilizing these Roth conversions, potential sale of your rental properties long term. These are things that are going to lead to a higher probability success in addition to the recommended investment allocation, which we'll walk through here in a moment. So all of these things are contributing to this probability of success that's outlined. And so, again, the reason that we're making recommendations such as this, these Roth conversions long term, is it helps us to increase that probability of success. Again, gives you more after-tax earnings. And so going back to the recommendations document, you'll notice either selling the business, which I don't have that included in the plan today. Businesses can be sometimes challenging to evaluate their worth as of today, and it changes and fluctuates over time. If we do end up selling the business, that's something that we can look at a little bit more in depth in the future. For now, I'm just going to leave it out of the plan. Easiest thing that we can do to supplement retirement savings, I've assumed that we're selling our rental properties at retirement. If you love these rental properties, then let's have a conversation to determine maybe an alternative there. But that, again, this is just a baseline suggestion. One thing I have not had the opportunity to talk about today, but we will continually discuss, financial plans are living and breathing documents. These are not things that are set in stone. This is obviously written in paper right now and on in ink, but good news is that we have this on file. We can always make changes, because you could call me tomorrow and you're like, hey, something changed. I just lost my job, or I just got disabled, or something happened to where our finances are changing in the near future. Well, financial plans are living and breathing things, and some of what we do holistically is to protect against some of those things. So just keep in mind, financial plans, living and breathing. Investment planning. Again, I know I'm jumping around here. My plan was to share with you these, what are they called? These graphs. I was planning to share these graphs through our financial planning software, because it's a lot better interface, in my opinion, to look at. Utilizing the document, not as great. So again, we're just jumping around this document a little bit. So And again, normally I would be sharing my screen in this circumstance. So just give me a moment here. I'm going to go to page 25 of the PDF. So when you take a look there, page 25 of the PDF says 21 on the document itself. This shows your current portfolio versus the recommended portfolio. Notice our risk profile is low. As of now, our current asset allocation is 60% stocks, 40% bonds. Not a bad portfolio. When we look at historical return rates, when we look at portfolio analysis, 60-40 is actually a decent portfolio and has performed well historically. That being said, given our current trajectory towards retirement, given our desire to retire as soon as possible, and maintain our current lifestyle, I think it's warranted to take on a little bit more investment risk whilst not, going full bore, pedal to the metal. So the recommended asset allocation is there on the right. And in total, this kind of comes out to an 80-20 portfolio. It's about 82% stocks, 18% bonds, and some cash in there. And there's also a broad diversification. We have global diversification as well as domestic diversification. We've got stocks and bonds, but not just stocks. We got large, small, medium stocks. We've got, I guess not mid-cap stocks in this case. We have large, we have small cap stocks, we have value stocks. We've got bonds, both long-term, we've got intermediate and short-term bonds. We also have some cash in there. And we also have international, like I mentioned. So we are diversifying the portfolio both domestically as well as internationally to ensure that we are protecting our assets and diversifying as much of the risks out there that we can. There are some risks we can't diversify against. For instance, if the country were to go to war, whether that's the United States or some other country, that's risk we can't really protect against. It's more so things like business risk, concentration risk, entity risk, interest rate, credit risk. These are things that we can minimize by spreading our wealth across multiple different sectors and industries of the market. So this is the detailed synopsis of the investment allocation. I'd say for somebody in your age bracket, I'd say 80-20 is probably on the lower end of the risk profile. If we were more aggressive, I might recommend a 90-10, maybe even 95-5, because we still have a pretty long trajectory towards retirement. And that reminds me, one of your bigger questions is probably, when can we retire, right? That was your number one question that we wanted to make sure to address. I've talked a lot about how we need to make adjustments to get there. Based upon the recommendations that we've talked about up to this point, I have some other ancillary financial planning recommendations that we can discuss further, but based upon the recommendations that we have talked about up to this point, the most realistic and recommended timeline would be to retire at age 67 for John and age 65 for Jane. Now, it'd be great if we could retire earlier. If we did that, it would require some even more adjustment to our long-term spending. Even now, I'm assuming that we are spending $30,000 in today's dollars during retirement per month, which is within your cash flow. I think it's possible to live on $30,000 per month. But right now, we're essentially spending $53,000 a month. And as I mentioned at the outset, cash flow is negative. So sustaining current lifestyle, it's not really sustainable today. It's not going to be sustainable in retirement. So I projected out the most realistic lifestyle that is possible without making too big of a sacrifice. That $30,000 kind of works out to 80% of where we're at today. If we went down even further, let's say that we, instead of living on 80% of where we're at today, if we went down to say 70, maybe even 75, our probability of success goes up more and we can potentially retire a little bit earlier. Like I said, financial plans, they are not set in stone. These are things that we can continue to evaluate over time. For your all's sake, biggest points of emphasis are cash flow. We need to minimize that, find a way to get a better hold on that so we can have some positive cash flow. Opening up some retirement plan assets like a SEP IRA for John, Jane, if we have a 401k or a retirement plan available at work, maybe perhaps looking into that, because that's another way that we can optimize for retirement. And then certainly allocating our investments a little bit more aggressively. To that end, while we're on the investments conversation, there were questions regarding the equity compensation. I addressed this in the financial planning letter, so I would encourage you to take a look at that. Generally speaking, equity compensation, it's a form of compensation by your employer to incentivize you to perform or to stay at the company for an extended period of time, and it's a reward, right? You have different types of equity compensation. As in your case, Jane, we have restricted stock or RSUs. We have stock options, incentive stock options, and then another type of restricted stock as restricted share arrangements, RSAs. Now, generally speaking, what we'll do in these scenarios is we're going to sell them pretty quickly after we exercise, especially in the case of like an RSU, so restricted shares. The way these work is the second that you become vested or you own rights to those shares, that counts as taxable income. So if you have 20 shares and they're all worth $10, that means that you are going to earn $200 right there on the spot, and you get taxed as such. Once the grant has been made to you, you then have the option, or once you're vested in that grant, you then have the option to sell it. If you don't sell it right away, it's possible that that could increase in value. Let's say our $200 now grows to $300. If you then sell it, you pay tax, you pay capital gains tax on that growth. What's more, we have to consider the time period. Let's say today, which is January 24th, let's say that we decide to sell this stock, and we were granted it vested, let's say it vested on October 25th of last year. Well, that's within a year. Therefore, that growth, let's say the 200 to 300, that would be taxed as ordinary income. So you guys are in the 32% tax bracket today. That growth would be taxed at 32%. So you'd only get 68 cents on the dollar. Versus, let's keep the growth the same, 200 to 300. So we have $100 worth of growth. But instead of selling it today, remember we got the stock on October 25th. Let's say we sell it in November of this year. Well, now we've met the holding period requirement of over a year. Now that we've held it for more than a year, we can now sell it and only pay long-term capital gains. And as of now, based on your guys' income, that's roughly about 15% capital gains tax. So now we get 85 cents on the dollar rather than 68 cents. So big advantage, especially in your guys' case. So that is one thing to consider. Generally speaking, though, I'm probably going to have us sell these at our earliest opportunity, right after they vested, these restricted shares, because you pay that income tax, you can't avoid that, but we can avoid any capital gains tax, A. B, we can also avoid concentration risk. One of the problems with portfolios is, or I should say with equity compensation, or I should say one of the risks associated with equity compensation, is that it can create a large holding in one single company. Well, when we have large portions of our portfolio in one single company, that's going to have an influence on our overall portfolio, and I would say a large influence, probably potentially detrimental. Could also be contributory. If the company takes off, then your stock takes off too. And so just for one, we have to understand that risk, but two, generally speaking, we're going to diversify that. And so in the case of RSUs, we're going to go ahead and sell those. Now, depending on how much are vested, and that's one of the questions I outlined in the letter, we want to determine to what extent are some of these vested, because I have the vesting schedule with some of the RSUs, and it says like some of them are 50% vested, some of them are 25% vested, others are close to 100% vested. We have other shares that are potentially older. If you could specify or hand over the grant date information, the exercise date, the expiration date, any and all information pertaining to those shares, that can better inform our strategy. I can't give you an explicit recommendation on, oh, hey, we should sell, 200,000 today or 50,000 today, because the other thing we have to take into account is, what tax implications are already present. So if we have a statement on any of those existing shares, that's going to help inform the specific strategy that employ. So I'm speaking very high level right now because, again, there's just some information that we're missing there. In the case of your ISOs, your incentive stock options, these work a little bit differently. When you're granted, you don't pay any tax. And then even when you exercise, you have the option to hold on to that stock, and you don't pay tax when you exercise it. And once you have exercised, usually you want to exercise after that, at least a year after it's been granted to you. And then you'll sell it after a year of exercise. So you'll notice that timeline works out to, when you sell it, it's 2 years after it was granted to you and 1 year after you exercised it. That's what's known as a qualifying disposition. Basically means you'll get favorable capital gains tax treatment on the value of that stock. The other thing with incentive stock options is usually you can buy them at a discount, right? So maybe the stock's selling at $30, but you can buy it at $25, for instance. So that's how incentive stock options work. So again, need some more information to clarify where we're at on some of those stocks, when they were granted to you, if they have been exercised, and when the appropriate time to exercise would be, and if maybe we're in a position to sell any of those shares, we can look at that. Again, the long-term strategy is going to be to diversify away from those, just so we can provide more risk-adjusted returns in the portfolio. So those are at a high level how those ISOs work, but just keep those things in mind. Just peeking at the investment recommendations there. Keep in mind, it's helpful to consult with your CPA on any of these tax things. As your financial advisor, I can't provide you any tax advice, but I can provide you education on things to consider related to taxation. So that's one thing to keep in mind as well. And then I'll go through these relatively quickly. So on the last 3 areas of financial planning on the next page. Education planning, that was one of your questions. How can we fund education for our kids? Because Jarius, I believe, let me just double check. I think it's Jarius who's 18, right? Yep. Jarius is 18, so we're likely going to school later this fall. In that case, we'll probably just utilize available assets, whether that's some cash that we have on hand or some of the money that's invested in brokerage. One of the things we'll need is, and I mentioned this in the letter, we'll need a copy of the statement for the brokerage account, because of course we need to take into account taxes. If you bought, let's say, $500 worth of stock, and now it's $1 million, you've got $500,000 worth of growth on that stock. And so if you sell any portion of it, about 50% of it's going to be taxable as taxable as capital gains. So that's something that we're going to have to look at in terms of like that specific strategy. But in all likelihood, we'll utilize some cash as well as the brokerage assets. You can open up what's known as a 529 plan for Jarius. You can also open up for June as well as JP. 529 plans are basically tax-advantaged education accounts wherein you can withdraw any earnings on those assets tax-free. So if you invest $100 and it grows to 500 and you withdraw for a qualified education expense, let's say for books or room and board, for instance, you pull out for that qualified education expense, you don't pay any tax on that $400 worth of growth. So super nice, right? On the other hand, inside of a brokerage account, you pull any money out for any reason, you have to pay tax on any growth that is present. So that's where the 529 adds its advantage. Downsides of 529 plans is they are essentially built for education solely. So let's say you put money in the account, years go by, maybe Jarius, June, or JP, they get a scholarship. You can actually pull money out dollar for dollar based on the scholarship. But maybe they just don't need as much as you put in the account. Maybe there's $100,000 left over. If you pull that out for a non-education related reason in the future, you will pay income, you'll pay tax on the growth, so capital gains tax and any investment earnings. You'll also pay penalty of 20%. I believe it's 20%. It's 10% or 20%. So you're going to pay tax penalty on that distribution. So that's one thing to be cautious of. Again, otherwise, excellent vehicles for education. The other advantage is you can save quite a bit. Retirement plan assets, depends on the asset. Like a 401k plan, you can contribute $24,500 into it in 2026. Or you can save, like we talked about the SEP IRA earlier, you can save 25% of compensation or $72,000, whichever's less. Like there is flexibility to save, but there is generally a cap, a limit on how much you can save in various retirement plans. 529 plans, usually they're based upon the state. So states will have their own caps generally, but they're usually pretty high. Like for instance, I think California is like $500,000. So they're generally very high. Also, anytime you make a contribution to a 529 plan on behalf of one of your children, that's considered a gift. Well, there is what's known as a gift tax exclusion here in 2026. That amount is $19,000. So let's say you put $19,000 in an account on Jarius's behalf. You don't pay any tax on that. If you elect gift splitting, again, this is more of a estate planning conversation, but if you elect gift splitting, well, both John and Jane, you can contribute $19,000 on the behalf of Jarius. That's $38,000 all in 1 year. Let's take it one step further. Not only can you contribute, upwards of $38,000 and not have to worry about any gift tax for a single beneficiary. You could contribute $38,000 to each child in a single year, and you wouldn't pay any gift tax. You can also do what's known as super funding. This is a very unique loophole with 529 plans. In essence, you can fund 5 tax years all at once. So this year, next year, the year after that, and so on. It's based on this year's annual exclusion, so $19,000. Multiply that by 5, that comes out to $95,000. You multiply that by 2, if you're both electing the gift splitting, you could contribute $190,000 on behalf of one of your children. So quite a bit of flexibility all at one time. So again, if you wanted to utilize a 529 plan for Jarius, you can do that. Just keep in mind though that again, the risks associated with tying those assets up. My recommendation is going to be a split between the two. Have some 529, have some brokerage, so that way if we get to the end of our college funding with all our kids and we got some money left over, hopefully we've just minimized the amount inside the 529. Also, keep in mind, you can rename beneficiaries. So if you ever want to go back to school, or even most recent legislation has now given the ability to where you can use it for credentials. So like if there's a certain credential that you want to obtain based upon your job, you can actually utilize the 529 plan to pay for that. So it's incredibly flexible. It's like a Swiss Army knife nowadays. There's a lot of different things you can use it for. But again, it's primarily for that education purpose. So my recommendation would be a mix between those two. The one final thing I'll talk to on education needs is currently my assumption is based on in-state 4-year education, public in-state 4-year education. That's the assumption I've made. What we haven't discussed, and something we'd like to talk about in the future, is what does education funding look like? Are we thinking, I want to fully fund college? Are we thinking partially funding? I mentioned this at the outset, worth reiterating. Are we thinking public or private? In-state, out-of-state? That obviously has an influence on these expenses. I did run an analysis earlier when I was doing your life insurance calculation, and I'm basically estimating in today's dollars, we need about $334,000 today to basically fund all of your kids' education. Discounting future needs in the future back to today's dollars, in essence, we need about $300,000 to fully fund all of your kids in a public in-state education. That's based on an average cost, which today is around $29,000. So that's the assumption we've made. We're also assuming that education tuition rates go up by about 6.4% over time. And historically, we've seen that, the inflation rate's around 2 to 3%. We have seen historically that education tuition rate can be somewhere around 6%, at least double that of the inflation rate for everything else. So taking all those factors into account, again, that's based upon that public in-state education. If that looks different, let's have a conversation. We can adjust the plan, and we'll talk about alternative scenarios there. Moving along here, protection planning. One of the things with risk management, obviously we talked about diversification inside of an investment portfolio with your assets, but there are other ways we need to protect ourselves. For instance, in the case of disability, it looks like, John, we got some disability insurance in place. Would love to confirm what amount of coverage we have and what the provisions look like to see if we need to make any adjustments there. Again, we can advise on that. We can have a separate conversation. Life insurance. I didn't see anything that spoke to life insurance specifically. Given that we still have 3 dependents, even Jarius, who's about to go off to school, he's still technically a dependent. I guess he is age of majority. I'd have to check if that's true in Georgia. But specifically for June and JP, if something were to happen to the both of you, we need to make sure that they're protected, or if at least something were to happen to one of you. So because we're still going to be funding education for the next 10 years, I'm going to recommend 10-year term insurance policies. Term insurance, it's like it sounds, it's for a period of time. So in a 10-year period, that means you're protected for those 10 years. And then after that, the coverage subsides, or you can do, if you purchase a convertible policy, you can convert it to a different type of life insurance. Again, that's more of a future conversation, but I'd recommend the 10-year term because in the next 10 years, we're going to fully fund education for all 3 of our children, right? Or at least be very close to that. We're in 2026, 2036, we'll be finished with funding education. So I'm recommending that 10-year term. Now, what's included in these calculations, I've recommended $6 million for John and $5.6 million for Jane. This includes future income. So here's our current income, multiply that by 10 years for both of you. We're also including outstanding debts, so $2.5 million of that. We've got mortgage that's outstanding, both your primary mortgage as well as your rental properties. And of course, we got education built into that. So I just mentioned the $330,000 in today's dollars. Usually when we calculate life insurance, we factor in, okay, can we help pay education for kids? And then last but not least, bereavement and burial costs. Last thing you want is to stress about, moving on from the loss of a loved one. This can help alleviate some of that stress. You can't replace, it's funny, in the finance world, we have this method called the human life value method, basically calculating the value of a human life. Very difficult to quantify, right? But nonetheless, if something were to happen to one or both of you, having some extra money can really come in handy. And depending on how the estate plan has been set up, which is something else we're going to talk about here briefly, it can also be a protector of the estate and really pay off some of those estate expenses, if applicable, maybe in the event that we both pass, in the worst case scenario. Death benefit proceeds from your term life insurance, completely tax-free. There's also something known as an unlimited marital deduction, so meaning that anything, if one of you passes, let's say John predeceases Jane, Jane gets everything, doesn't have to worry about any estate tax at that point. Talked about disability coverage. Again, do want to confirm what current coverage is. And then long-term care insurance, based on your current age, can run a bit high. And I don't think it's necessarily the most important coverage to have in place today. Probably more a conversation to have once we're in our mid-50s to 60. That's usually the most optimal time to get it. Downside with long-term care insurance, it can be expensive. I've seen in the past where self-insurance can be a viable option. In your all's case, because we have some work to do on the retirement trajectory, we're probably going to be looking at long-term care insurance, and one of the options could be a rider on a life insurance policy. So riders are basically just attachments to an insurance policy that once a circumstance kicks in, like a long-term care event, that rider would then kick in and support some of that long-term care need. So that can be a little bit more of a cost-efficient option to explore. Again, more of something we can talk about a little bit more in depth in the future. And then last but not least, we talked about your most important goal being retirement. We talked about education funding. Those are your two highest priorities. Of course, we talked about the opportunities available cash flow. The last and most important thing we need to make sure that is in place is estate planning. I did not see any information that confirmed whether we've got things like a will, a living will, or advanced healthcare directives, right? These are critical documents, and I'll just give you a brief overview. Last will and testament basically outlines your wishes. Hey, I've got this personal possession. I want it to go to so-and-so family member, or I just want to leave it all to my kids. This is how you'd spell it out in that document. Some people, they don't even have formal wills, and maybe you've read books where like, I leave everything to this person, that person, and my cousin Jerry, and it's just spelled out on a piece of paper. Estate planning documents are a little bit more comprehensive than that. So like a last will and testament. A living will. If you're incapacitated and you cannot make decisions on your behalf, you want to make sure to have provisions in place. This is where an advanced healthcare directive comes into play. Basically, if you can't make healthcare decisions, who's going to make that on your behalf? If you don't have that spelled out, HIPAA has privacy protections and they can't disclose certain information, and basically that decision is going to be made up to the hospital. Whereas on the financial side of things, again, you're incapacitated, you can't make decisions. Financial power of attorney gives the power to someone to make decisions on your behalf. Now you have what's known as a springing power of attorney, a durable power of attorney, or immediate power of attorney. Usually the best way to go there, and you can talk with your estate planning attorney about this, is an immediate power of attorney, because that means they already have the provision in place. So in the event something happens, they can take immediate action. Versus, let's say it's a springing power and you become incapacitated. Now that financial power of attorney is going to kick into gear. It can sometimes take some time for the attorney to go into force. And sometimes when a life circumstance like that happens, you kind of want those things to be addressed pretty quickly. So that's just a consideration there. And let's see, there are a couple of things I outlined on the estate planning recommendation. Oh yes, for you all, one of the biggest things to consider is guardianship for children. Jarius, obviously, we're 18 years old. He is legally an adult in many states, so maybe not as great of a concern, but he still lives at home. You might still want to have some provision for him, at least in the near term. But especially June and JP, if something were to happen today and both of you aren't here, who's taking care of them? You want to make sure that is spelled out in detail, that you know who's taking care of it. Otherwise, it's going to go through probate, and ultimately the courts are going to make that decision on your behalf. I don't want that for you. You don't want that for you. So that is one of the biggest things we want to make sure that we're taking into account. So that is the list of recommendations. Again, I know your biggest priority is retirement planning. And based upon the recommendations I'm outlining to you, making adjustments to cash flow, opening up a retirement plan, optimizing for taxes and investments long term, if we implement all these things, at least based on the present point in time, I believe it's very realistic that we can retire at age 67 and 65 and maintain a lifestyle that's relatively close to our current lifestyle. Again, we're projecting $30,000 per month in retirement income. So I hope that this is helpful. Again, I've provided you the letter that spells out some of the information we discussed today. I'll also be providing you an email that just kind of spells out what we discussed in this conversation. And obviously you have the financial plan to reference. If at any point in time you're going through this information, you're like, you know what, Michael, this is a little, I don't know, it doesn't make sense, or I have some questions on it, feel free to reach out via phone or email at any time. Beyond that, in terms of next steps, again, I think the biggest thing are fill in some of those gaps. I have that letter open here. Let me just go ahead and grab it. Financial plan letter, just for reference. So a couple of things we need include, if you have any life insurance, confirmation there, basically any of our insurance policies, if you could just send those my way so we can take a look at them. A pay stub for both of you. This will just verify any benefits that we have through our employers. There was mention of umbrella insurance as well as car insurance, medical insurance. If we could just have the statements, the policies for those, so we could verify that information. Beyond that, we need to verify the business structure for John. Again, normally we'd probably just have dialogue if this was an in-person conversation. Statement for the brokerage accounts, again, just to make sure to determine what the tax consequences would be, because I'm recommending a reallocation of assets. One of the things that we're going to do upon implementation is be tax efficient. We're not just going to, in all one fell swoop, all right, we're going to reallocate the portfolio today. We're going to analyze, okay, based upon the tax consequences of the reallocation, how much can we realistically allocate within a given year based upon the advice of a CPA, so that we're making sure that we're not overburdening you or overexposing you to taxes. Make sure to provide me some mortgage statements. Just want to confirm if indeed my calculations are accurate and we are shortfalling on the mortgage. If not, and we have some rental property income also, that's another piece of information I want to make sure to confirm. So I know that was a lot of information. I know it's kind of drinking from a fire hose a little bit. What questions do you have? Let me know. Please follow up with me. I want to make sure that all this stuff is making sense. One other piece of information we talked about, the equity compensation. Again, have kind of limited information apart from the RSUs and how we're currently on the vesting schedule. Just some more information on the grant date, the exercise date, expiration. Having this information on hand make it a lot easier to provide a more explicit recommendation on how we're going to reallocate those assets long term. All right, John and Jane, hope this is helpful. Thanks so much for giving me the opportunity to build your plan. As always, if you have any questions, please let me know. All right, take care, guys.